All right, let's dive right in. If you're here, it's probably because you've decided it's time to make your money work for you. But let's be honest, the world of investing can feel like this huge, complicated maze, right? Well, in this explainer, we're going to cut right through all that noise. We're going to lay out a super clear, simple guide to the main ways you can invest. And we'll look at the good, the bad, all of it. Okay, let's get to it. Does this look familiar? You hear people talking about stocks and crypto and gold and a million other things, and you're just not sure where to even begin. You've got the goal, you want to invest, but the biggest thing on your mind is, I just don't want to lose the money I've worked so hard for. I get it, and you are in exactly the right place. We're going to break this all down piece by piece. So first up, let's talk about the most common starting point for almost everyone: owning a small piece of a business. You might hear this called equity or variable income. Why variable? Well, unlike a paycheck that's the same every month, the returns here aren't guaranteed. They can go way up or they can go down. But historically, it's been one of the most powerful ways to build wealth. The good news is you don't have to put all your eggs in one company's basket. And that's exactly where index funds come into play. Just think of it like this. It's a giant shopping basket that holds tiny slices of hundreds, sometimes thousands of different companies. So instead of trying to be a genius and pick the one company that's going to take off, you're just betting on the whole market growing over time. It's diversification made easy. Okay, now let's look at the actual numbers, because this is where it gets really interesting. Take two of the world's most popular indexes. The S&P 500, which is basically the 500 biggest companies in the US, has returned, on average, over 12% a year for the last decade. That's fantastic. But look at that biggest drop, a 56.8% fall. And it took almost 4 years to get back to where it was. The MSCI World Index, which is global, tells a pretty similar story. Really strong returns, but you gotta be ready for some serious bumps in the road. So it really all boils down to this trade-off. On the one hand, you've got this incredible track record of powerful returns, and it's a super simple way to spread your risk. But on the other hand, you have to be mentally prepared for those big market crashes that can and do happen. It can take years to recover, which means this is absolutely a long-term game. Okay, so that covers owning pieces of companies. But maybe you're someone who's more comfortable owning things you can, actually see and understand. This next category is all about that: investing in real physical assets. Think property, think precious metals. So how do you invest in property without actually buying a whole building? Well, a fantastic way is through something called a REIT. These are basically huge companies that own and operate massive portfolios of real estate. We're talking shopping malls, apartment complexes, and even more modern stuff like cell towers and the giant data centers that power the internet. When you buy a share, you're basically collecting a tiny piece of the rent from all of those properties. And this is a great example of just how diverse this space is. You've got a company like Welltower focused on healthcare buildings that's seen returns of almost 16% a year. And then you have Equinix, which owns the data centers our whole digital world runs on, also doing incredibly well. But just like stocks, they're not immune to big drops. The recovery times, though, can sometimes be a bit quicker. All right, now for an asset that's been around for literally thousands of years: gold. You'll often hear it called a safe haven. Why? Because when things get chaotic in the markets, or when inflation starts to creep up, a lot of investors run to gold because they see it as a reliable way to protect their money's value. It's not there to make you rich overnight. Its main job in a portfolio is defense. Now, looking at the numbers, gold has actually delivered a really solid return over the last decade, right up there with some stock indexes. But, and this is a big but, look at that recovery time: 2,290 days. That is over 6 years. 6 years to get back to its previous high after a major drop. So if you're investing in gold, you need to have some serious patience. Okay, we've covered the traditional stuff. Now let's get a little more adventurous and venture into what's called the alternative frontier. These are investments that, until pretty recently, were mostly for big institutions or the super wealthy. They definitely carry more risk, but the potential rewards, well, they can be huge. Have you ever wondered how people get in on a company before it's a household name and listed on the stock market? Well, that's the world of private equity. These funds go out and buy big chunks of private companies, hoping to help them grow, and then sell them for a massive profit years down the line. It's like getting a piece of the next big thing before anyone else. And the returns can be absolutely incredible. The giants in the space, firms like KKR and EQT, have a history of delivering returns that blow the public stock market away. But here's the catch. and it is a big one. Your money is not liquid. When you invest, your cash is typically locked up for 5, 7, maybe even 10 years. You can't just wake up one day and decide to sell. All right, next up is an asset that probably doesn't need an introduction, but it definitely needs some explanation: crypto. It's a world of total contrasts. On one side, you have this revolutionary blockchain technology that some people think could change finance forever. And on the other side, you have some of the craziest, most extreme price swings you will ever see. Just take a second and let that number sink in. An average return of over 75% per year for a decade. I mean, that is the kind of explosive, mind-bending growth that has pulled millions of people into Bitcoin, all hoping to get a piece of a technological revolution. But for every one of those incredible stories of getting rich, there's been an absolutely brutal crash, a drop of 83%. To put that in perspective, if you had put $10,000 in at the peak, you'd be looking at just $1,700. That's the raw, brutal reality of this kind of investing. You have to have the stomach for it. And this slide really puts it all together. Bitcoin's journey has just been a complete roller coaster. And then you look at Ethereum, and the numbers are even wilder. Crazier average returns, but also a jaw-dropping crash of almost 94% at one point. So the big takeaway here is that while the potential is obviously massive, the risk is just as extreme. Phew. Okay, after that crypto roller coaster, let's just take a deep breath and talk about the exact opposite: safety. Look, not every dollar you invest should be a moonshot. A really important part of any good strategy is just preserving the money you already have. And that is where fixed income comes in. You know, the easiest way to think about bonds is that you're basically playing the role of the bank. You are loaning your money, usually to a government or a big, stable company, for a set number of years. And in return for that loan, they promise to pay you a fixed interest payment, like clockwork, and then give you your original money back when the time is up. It's all about being predictable and stable. And this shows you exactly how it works. Using some major government bonds as an example, if you lend your money for just 2 years, you can lock in a return of about 3.8%. But if you're willing to part with it for 30 years, that return jumps to over 5%. You're basically getting paid more for your long-term commitment. It's a great way to secure a predictable income for years to come. So we've walked through stocks, property, gold, private equity, crypto, and bonds. Wow, each one has its own personality, its own job to do. But you know what? The real magic happens when you start combining them. So let's look at how you could actually build a blueprint for your own portfolio. Here's just one example of what a modern, growth-focused portfolio could look like. You see the foundation, the biggest chunk at 70% is in stocks for that long-term growth. Then you have these smaller, more strategic bets, 7% in private equity and 5% in crypto for that higher risk, higher reward potential. And finally, about 18% is kept in safer things like bonds and cash for stability and to have on hand for emergencies. Now, let's compare that to how the world's wealthiest families actually invest, according to research from Goldman Sachs. What just jumps off the page here is that massive 42% slice dedicated to alternatives like private equity. They still have a ton of money in stocks, but they put way more into these less common, high-potential assets than the average person. For them, that's the real engine of wealth generation. So we've covered the different methods, we've looked at the real data, the pros, the cons. You've seen how these different assets behave and how they can fit together. The real question now isn't if you should invest, it's how. The tools are out there, the information is more accessible than it's ever been. So, what's your first step going to be?